Hello everyone, Michael here. Today's video will be a bit of a lecture, a short analysis of what is happening in the markets and what is most likely going to happen this year. So I will put forward a few theses which in this video I would like to support with specific arguments. So I would like to point out right away that I will not try to discuss the prices at which the assets would be in 3 or 6 months, but I will talk more about the trends that should follow and the direction of prices. So first, I'll say that the dollar will rise in value this year, and after the volatile first half of the year, the equity markets will end in green even more than a year before. So let's answer the question first, why does the current market situation seem to be quite negative? The S&P 500 has fallen by 5 to 6% in the last dozen of days. For some investors, this is a terrible drop. Some of the companies have fallen by 10 to 5, sometimes even 7%. Of course, it all depends on the companies. FANG itself, which is Facebook, now Meta, Amazon, Apple, Netflix and Google, has fallen relatively little. In fact, FANG almost always performs the best in such an environment, which is why these declines in companies such as Google, Apple or even Microsoft are statistically much smaller. Of course, it all depends on the period and on the beta. As a reminder, the beta is a value describing the volatility, i.e. the deviation from the benchmark. So if you assume in our case we study share prices, our benchmark in this case is the S&P 500. Then, in this particular case, any value below 1 or above indicates a deviation from the average, and it is either a smaller or greater deviation. If a given entity X has a beta of 2, in practice this means that it is 2 times more volatile over the given period than the broad market. On the other hand, if this beta is 0.5, it means that the volatility in relation to the broad market is 2 times lower. So if someone wants to select assets, for example, from FANG and wants his portfolio to fluctuate as little as possible, he should follow the long-term historical beta, i.e. select companies with the lowest possible deviation from the average volatility ratio. Okay, now the current market situation. Some people say the late bull market was supposed to be cool, and yet we have a downward move. Here I can say right away that this year will end with a pretty good, even very good plus. If any of you are interested, I encourage you to watch my videos where I have been building such a portfolio since October last year. Plus sometimes I add day trading positions with a lower risk due to the fact that these are my private funds and sometimes some experimental trades sneak in there. Anyway, at the moment I'm in the plus area of about 20%, and always in addition to discussing added or removed position, I discuss some interesting issues, including often debunking myths that circulate on the internet, such as the fact that QE programs or colloquially printing money causes inflation, etc. So, after watching this video, I invite you to watch the videos of the Traders Journal series. But returning to the topic, this year will end in positive territory, but due to the political and presidential cycles that I will describe in a moment, the first half of this year will be relatively weak, negative, and in particular will be relatively volatile. From the point of view of presidential cycle statistics, the second year of any president, whether Democratic or Republican, is statistically the worst period, especially in the second year of a Democratic president, because the first year is always very positive, provided that the president in the initial phase of the election was demonized. I applied this to Biden, who was supposed to introduce so many negative things from the point of view of the market, which is higher taxes, etc. And in fact, he did not introduce anything, so you can see that the market is a game of expectations to reality. If the expectations were low, it created uncertainty and fear, and the reality turned out to be positive. The market made up for it. Therefore, Biden's first year was one of the best, if not the best, first presidential years in history. On the other hand, a year second is the last possible period for the introduction of negative legislation. We must remember one thing that I am constantly reminding you in the videos, that the market doesn't tell us what is going on right now, but about what will be between 3 to 30 months from now. This range changes from time to time and depending on the market situation. In practice, this means that If there is any panic on the market, the observation range initial valuation of all commonly known information usually starts from 3 months. Unless there is really a very super strong correction caused by some fundamentally harmful factor, as it was in the March, then this range is even closer than 3 months. But in a normal market environment, preliminary valuation is based on a range of 3 to 5 months, which is exactly about half a year or the next 6 months. So the market is pricing in all the well-known information, and what Benjamin Graham said, that the market itself behaves a bit like a person depressed, a person whose moods change rapidly, and a person who has a certain characteristics which can be said to be almost always pessimistic and not perceiving positive information, except of course when there is a euphoria that causes the market to suddenly become above average optimist. But all the time in a normal market environment, as a part of a maturation of the bull market, the market assumes not a worst case scenario, but rather a low positive one. And as you know, the American system is very well structured from the political point of view, because there is something called a very strong political impasse there. For those who don't know what a political impasse is, this is a situation where any political party, due to the complexity and federalization of the system, is not able to introduce a specific legislation, i.e. to vote its political actions, both positive and negative. The market likes most situations/environments in which neither positive nor negative actions can be carried out, because each action, whether positive or negative, can have long-term effects that are difficult to evaluate. It can create a period of uncertainty that the market hates. And on the other hand, it creates winners and losers. For example, this sector X tax cut and this sector Y increase tax situation. This creates winners and losers. And this is of course negative from the point of view of the market. So the situation in which it is what it is okay. It is not super good, but it is okay. This is an ideal option for the market, and the market realizes one thing, that Biden and the Democratic Party in general may still pass the last negative legislation in the last 6 months. Negative from the point of view of the market, which can affect the profits just 3 to 5 months, and the market is pricing it in. So you have to put yourself in the position of the market for a moment. You are the market, and you realize that perhaps they will introduce something negative in the House of Representatives or in the Senate. If you are aware of this, you already have lower expectations of reality. He will probably not do it because Biden turned out that he does nothing after all, but the market is discounting it. And the market does not know what is he going to do yet. So he has to pre-price it, and this is what it is. The preliminary valuation is all about. That's why the second year of the president is not the worst year because it's just tragic. It's worst because it's a lot more volatile. The first half is negatively volatile, and this volatility is relatively bad for investors, but on the other hand, it creates opportunities. So if someone wants to pick stocks and needs stocks for a late boom market period, now many companies have fallen into a correction, so now it's a good time. Correction is a natural part of the market driven by sentiment. Additionally, elements such as inflation, the fear of hyperinflation, and the global rising of interest rates are the main threat of bond yields. Raising interest rates, previously there was a new variation of we all know what, then the European restrictions, etc. Those informations are extremely negative for the market from the point of view of investors' sentiment. Therefore, they cause a correction in a given segment and in a given period. Additionally, the real estate crisis in China and the crumbling Chinese economy. The mere fact that China was said to have incredible growth, and in fact it turned out that the Americans have overtaken the Chinese in terms of a real economic growth, shows a certain sentiment. In addition, failing developers in China such as Evergrande and Shimano Property Group shows a negative situation from the market point of view. And so many negative factors associated with the presidential and political cycle can lead to a correction in the wide market. And you just have to endure it because the investment cemetery is filled with investors who have not withstood this volatility. 2018, This year also saw a global correction. All investors said it would surely be a bear market. This bear market did not take place, of course. And you have to endure negative periods. But okay, someone might ask, okay, then maybe it is better to sell the shares now for a period of time and buy back in 6 months. Or for example, I don't know, in August or June. This is also not a good strategy because we bear transaction costs very often, and besides, the recovery from the correction is very quick, i.e. the correction occurs relatively rapidly, the drops are aggressive, sharp, but the return to the old prices is also very sharp and fast. Volatility is amazing in the market as people don't realize how some assets can be volatile. We could check the largest companies even for the American market at the so-called 52-week price range. Let's call it price target. It would turn out that its upper and lower value have a difference of 50%, i.e. even large companies have volatility over time resulting from an increase in profitability, one-off events, sentiment, and many other factors at the level of 50% on an annual basis. It is hard to believe, but in fact it is true even for the biggest companies. I encourage you to check the 52-weekly price range of any asset. But okay, now let's figure out why the worst period will end in the middle of the year. Well, it's because in the United States we have a system based on the so-called average annual elections or the so-called midterm elections, and they fall in November 2022. It is a change of the House of Representatives and the senatorial part. Additionally, in some states, governors will change. Right now, the market in the United States evaluates the victory of the Republicans in these elections because it is a different party, i.e., it is the opposition party, which wins this type of election in relation to the presidential party. There are, of course, individual cases of a different situation, but in reality, the opposition party always wins. And additionally, there is the so-called redistribution of seats in the system based on single mandate district, and it is possible to arrange places in the so-called redistribution. The reality is that a party has had a slightly worse support in a certain region than in previous years, can win a lot more just by being able to arrange specific places and political figures. And these factors lead to a stronger dollar first, at least until November. And the market, which is now pricing in 3 to 5 months, needs to go through the last negative period. And now again, someone might say, if the elections are in November, why shouldn't the market behave negatively until November? And well, that's because Biden and the Democrats realize they won't be able to charge anymore, we can say, from around to June. Because in June or August is the last moment for them to introduce something relatively controversial, because in the American system the most important places in the United States are the so-called swing states. Most likely you heard about that. These are the states in which victory arises when the party asks for votes in relatively moderate, i.e. the demands are relatively moderate. If the Democrats, for example, in May, June, July or August, at the later date, in the beginning of the middle of the year, would start introducing a controversial legislation in the form of increasing taxes or the redistribution of wealth, it would, even from a PR standpoint, would turn out negatively. Swing states will choose the opposition party, further increasing the impasse in America. So creating a very strong impasse will arise after this election. There are many indications that the Republicans will strengthen their position, which will be a counter to the currently ruling party. In a nutshell, the market will start to grow again, and all 80 to 90% of the total cumulative rate of return will be created from the middle of this year due to the presidential cycles. This is due to a political cycle out of a political stalemate that will worsen and eventually lead to the transition from a year 2022, which is a Biden's second presidential year, to the best year for the presidential cycle, which is a third year, when the president loses power entirely, because there is so-called two-year rule. Already in the third year, the president tries to maintain his position in order to be nominated in the following years, and that his party does not lose its leadership. Of course, the opposition's narrative is that this is a poor economic policy of the party, etc. And we know that, for example, those problems, inflation, energy crisis, high commodity prices, etc., results from something entirely else. Okay, from now on I will start to summarize this mini lecture so as not to be boring for you. And finally, I can say that you need to watch out, because experts and gurus will scare you that the Fed has withdrawn the printing of money, so the stock market is going down, because that is what they will say in masses from around the world. Political commentators from Bloomberg and some other pseudo gurus will say, you see, I was right, the Fed stopped printing and the stocks go down. But in reality, it doesn't matter. The Fed people are probably much more cunning than you might think, and on purpose, this whole campaign to raise rates or tapering was launched in the second year of the president to make this cyclicality happen, to show that the Fed supposedly has any power, because from the point of view of the market and in fact reality, it does not have this power. And don't let yourself be fooled by the scare regarding this monetary policy. So finally, hopefully I helped in any way and to flip the picture on the current market situation, which is relatively negative at the moment. I can say that the highest quality liquid stocks, in particular the technology sectors, but not only, I will be carefully adding till August or June. So I think this is an interesting period. In the meantime, thanks for watching this video, and I'll see you in the next one. Take care, guys. Bye bye.